What's going on YouTube? This video, we are going to talk about Walgreens, ticker symbol WBA. Walgreens just announced their Q4 earnings of 23 on Thursday. So we'll go through the most recent financial release that they gave to us and figure out how this company is doing financially now. Year to date, this company is down 37.5% over the course of 1 year. Company is down 30 point, well, to basically 31%. Currently, this company is offering 8%, 8.2% dividend yield. Their short interest is 7%, so there's a good amount of short interest on this company. Forward-looking PE, basically 7, EPS forward-looking 3.39. We are probably going to use those two numbers in our calculator when we get to it. So we have valued this company before about a month ago, and I'll post a link to that video right about now. Valuation on that company came out higher than where it is currently trading, but since we got new numbers to go off of, analysts have adjusted their price targets and their EPS and growth rates and among other things that we can utilize to our advantage and figure out what our fair market value is on this company and see where that's currently sitting. So in case you don't know, a pharmacy operates a pharmacy-led health and beauty retail company throughout the United States and several other countries. They have 8,965 retail stores under the Walgreens name. International stores, they have about 4,000 international stores in United Kingdom, Thailand, Norway, Republic of Ireland, Netherlands, Mexico, Chile, and looks like 548 optical practices and 160 on a franchise basis. So quite a lot of stores. So let's look at their revenues and, well, their overall financials and figure out how, well, determine what they look like here. So we got a revenue, gross profit, both flat, slightly declining. Our net income was heading back higher to more normalized levels, but as of lately, it has then taken a sharp turn negative on their net margins. So our gross margins, you can see, are declining. Although even though they were declining, it didn't seem to impact net margins too much over there. So revenue, gross profit, year-over-year change, really just there is not much for growth at this company. It's just it is just a flat, maybe 1% type grower, so not looking for too much growth at this company whatsoever. Return on invested capital up until 2020 was looking decent. It was within line typically with where retail stores sit at about 10%, but since then they have not been able to recoup that. Short-term debt to cash, they got an incredibly large amount of debt to cash. They've got less than $1 billion in cash, but $26 billion in debt, and that's in short-term debt. Come over here to long-term debt. They got $69 billion in long-term debt and only $970 million in cash. If we do look at their cash real quick, we can see they went from $2.5 billion in cash down to $970 billion million dollars in cash. So they're burning through their cash. So that's something to be probably concerned about. We can see up here how their cash is trending. Total cash is right here within short-term investments. So, looks like cash consistently is, I guess, within range of where it has been, but it's trending in the wrong direction quickly, which is definitely concerning, although it's done it back. Oh, it's really definitely did it right back here at 10 billion in cash down to 3.3. So, yeah, I don't know, something to keep an eye on for sure, especially with how this company is doing financially. It's not looking too good at the moment. So, and our inventory at this company is also shrinking slightly, so that's good. But anyway, net income to free cash flow. Net income obviously declining, and free cash flow is following, which is free cash flow is holding up better than net income, which is, something to look into to figure out why our net income or our free cash flow is higher than our net income. But we can see our free cash flow, how this is trending, kind of messy, honestly. It peaked and then since has rolled over and hasn't recovered since. Share count slightly declining, but since has stabilized for the last few years. Dividend on a upward trajectory. I think they need to knock that off and fix the financials at this company. Once they can get the company financials in order, then they can probably start going back to the dividend and buying back shares. Capital expenditures, they need to cut these out as well. They're sitting at 2 billion. They were, about 1.3 to 1.5 billion, but since have increased quite a bit. And this company is kind of getting destroyed financially. They had a lawsuit which we can see they went from 27 to $34 billion in SG&A, but that increase, majority of that increase was from their lawsuits, like $6 or $7 billion lawsuit. So that will correct once that gets settled. So over here on the financials, things just don't look very good, honestly. The stock chart shows that. So I mean, we can just see how beaten down this company is, and financially, it's just not looking very good right now. So one thing I want to share real quick while I was going through their press release, they down here in the chief executive officer's statement, they he noted and said, just 6 weeks, we have taken a number of steps to align our cost structure with our business performance, including planned cost reductions of at least 1 billion and lowered capex by approximately 600 million. So if they can do that, and that is true, then they anticipate seeing this happening in the second quarter of 2024. So in about 6 months' time, we should start to see hopefully that take place in the financials. And we could, if that happens, then that could add about $1.6 billion to free cash flow, which would make financials at this company look so much better. You know, if they can reduce $1 billion of capital or of operating costs and then reduce their capex by $600 million, that will help this company out quite a bit financially. But we have four other companies here to compare to. We have Walmart, Dollar General, Rite Aid, and CVS. We have several red flags currently. We have operating margin negative. We have return on invested capital negative. Operating cash flow is higher than our net income. And EPS growth forecasted is less than 5%. So pretty much we've already gone through all of that. Nothing new, but just a bit of a, you know, a lot of things that need to be taken care of at this company. We have our market cap to revenue. Walmart's kind of throwing this whole map off here, but I would say Walgreens to CVS is your best comparable, and we can see revenue in comparison to market cap as well, how much more strong of a company CVS is in comparison to Walgreens. Revenue, gross profit, and net income, we can see that same difference over here on CVS compared to Walgreens. Growth rate, same thing over here. CVS has a much higher growth rate in comparison to where Walgreens is currently sitting. However, the revenue growth rate about equal. Actually, Walgreens has a little bit higher revenue growth rate. Gross margin, we can see sitting 20%, CVS 16%. The competition is, you know, Walgreens is within the range of the competition. This is where things starting to get kind of really choppy everywhere. Operating margin, you know, sitting at negative, and you know, CVS sitting at about 4%. Profit margin, CVS still positive, sitting at about 1%, not very good. Walgreens negative. Free cash flow, CVS does have nice free cash flow currently, and Walgreens, obviously we already went over, does not. Return on invested capital, same thing, 5% over here at CVS. So Walgreens negative. Price PE, obviously Walgreens is currently has a negative EPS, so this is not going to have a positive PE. And CVS currently trading for what I would consider quite a bit of a premium, sitting at 32 PE. We can see CVS does offer a dividend of 3.3%, not quite as good as the 8.26%, but based on margins, I think CVS is a more safer bet, even though it's a lower dividend yield. Based on what we're seeing here overall in the financials, I would say CVS is a safer place for your money. Peter Lynch valuation. So let's figure out what this company is worth. So obviously we have a negative EPS, and that's giving us a Peter Lynch fair value right now of $10 per share. We are, again, a negative PE, so we're not going to get a price tag on comps. Price to book currently sitting at 0.68, 5-year average of 1.3, PEG ratio forward looking of 1.26. Grams valuation, again, negative, so we're going to have a negative number. Discounted cash flow, price per share. This is irrelevant as well because we're sitting very negative on the free cash flow, so this is not even a valid number to go by. Rule 72, I did plug in their future and forward-looking EPS and current PE, and I put them at a 6% growth rate. That gives them a fair value today of $18.19 per share. So what we're going to do is, because so many of these are negative, let's plug in their forward-looking growth rates and figure out. So I plugged in their forward-looking PE and EPS, and let's see now what we can get. So we still have a negative Peter Lynch fair value, mostly because our EPS growth rate is telling us that it is negative, but let's give them like a 2% growth rate. Let's see what that is. It's 2% growth rate gives them a Peter Lynch fair value of $7 per share. We'll get rid of Rite Aid because they are negative. That gives us price per share on this company of $83.15. Price to book still same. Peg ratio forward looking then would be, this would be more the forward looking number, not so much this. So this would still be it's in the same range roughly, but it's telling us it's fairly valued forward looking in the next 12 months. Grams valuation then gives us $36.35 per share. Dividend discount model $23.85 per share. Free cash flow will not change, and neither will Rule 72. So now we can come over here for our fair market value. I'm going to eliminate DCF here because that one is just kind of throwing everything off. So that gives us today fair market value of $33.72. Currently, this company is trading at $23.25. So our 30% margin of safety is $23.60. Analyst price target $32 per share. So we are right in line with where analysts are. Currently, we have a 30% margin of safety buy range on Walgreens, and we can kind of see where our price tags were on this company. So prior to us valuing this company, we valued this company a month ago, and we got $26.64. And we did the same thing. We used the forward-looking EPS and PE in the company. We got $26.64. So since then, we have been able to increase our fair market value on the company with the new numbers and analyst expectations of everything as well. So we can see where that's at. Now let's jump over the stock chart. We have a couple trend lines drawn in from probably prior video there, and we can kind of see it's sitting at the bottom of this range here. That was this channel that we drew in. And since then it has, and obviously this is setting up for earnings. We can see this is on the weekly chart. Once it chopped around at the bottom of this channel, and once earnings came out, popped up a little bit. Technically speaking, if there was a place to buy, now would be a good place to buy. We've got a few indicators telling us we have our MACD that's starting to curl back up higher. We've got our RSI telling us it's super oversold. Every time it hits oversold levels, it reaches a bounce. Almost every time here, we can see almost hitting oversold, bounced higher, a little choppy back here. Oversold, eventually bounced higher a little bit, but overall is still locked in this downtrend and probably going to stay there for quite some time. This thing might just chop around sideways for a while. So basically, if you buy this company, in my opinion, you're basically buying it for the yield of 8%, which is pretty good, actually. If you think about it, 8% yield on this company, and you might see some price appreciation as well. If this company is truly worth $32 per share, I mean, it's 30% on your money that you might get back too, and then plus a little bit of a dividend yield behind it too. So, but if you think Walgreens is going to stick around for the long term, then this might be a great buying opportunity on Walgreens. Based on technicals, you're sitting at the bottom of this channel. Every time it hits this bottom of this channel, it looks like it bounces higher. Financially, this company's got a lot of work to do, and it's trading like it's got a lot of work to do financially. If you compare this to CVS, CVS is holding up much better on their overall chart. Their financials are substantially better. Their dividend yield not as good, but it seems like this company has their financials in order. So you can tell that this one's not trading at all-time lows like what Walgreens is. It's got a long ways to go before it gets there. It's trading at more of a support range, I would consider it. So actually maybe broke through a support range a little bit, but currently trading at support. So based on the two companies, I think CVS might be a better buy than what Walgreens is. I know the dividend yield is very attractive at 8%, so it's hard to hard to hard to pass on that. But you also got to think too, like I'd rather get 3% and a company that's going to be hanging around for the long term with better financials than a company that is going to pay me 8% and potentially not going to be around in the near term future if they can't turn things around financially. So that's what I got for Walgreens. If you found value in this video, drop a like, subscribe, comment, and we'll be back later with another stock analysis video.